Good morning and welcome to the Data Explorers Securities Lending Daily Briefing. Today we're going to be discussing the SEC ban, the lifting of the ban on short selling in 950 stocks overnight, the reaction to the bank recapitalisation in the UK market. We'll look at Volkswagen, which saw a 55% intraday swing on Tuesday the 7th of October. And finally, we'll take a quick look at the cost to borrow in the Russell 2000 index. So the SEC has announced that the ban in short selling on 950 financial stocks was lifted at midnight last night. Looking at the Data Explorers Stock Loan Index, we have seen some interesting moves in the US, UK, Europe and Asia since the 1st of September. In the US market, the quantity on loan has risen by 20% since the 1st of September. In the UK, it's fallen by 16%. In Europe, it's 3% lower. And in Asia, it is 31% lower in October, having risen by 60% in September. Now, some interpretation on this might suggest increased volatility in the UK market. Liquidity in the UK has possibly been reduced because the inability to hedge out market risk by going long of one stock in a sector while shorting another, particularly in financials, has meant that there were fewer buyers for banks since the ban was introduced. Tony Jackson in today's FT Companies and Markets, page 20, argues that arbitrages in the HBOS Lloyds TSB merger have been prevented from going long HBOS and short Lloyds, which may have contributed to the violent price movements we've seen in these stocks this week. In Asia, we saw a big rise in the quantity on loan in September, followed by significant deleveraging in the 7 days of October so far. Moving on to the recapitalisation of the UK banks, we're in an unusual position here. Commentators such as Gillian Tett, politicians from all sides, and fund managers including Richard Buxton of Schroders and Keith Skeoch of Standard Life all seem to agree that this is a very good, well thought out, timely manoeuvre by the Bank of England, the FSA and the Treasury. This is sort of unprecedented agreement on this move. Moving on to Volkswagen. Volkswagen's share price in the ordinary shares moved from 290 euros up to 450 euros and back down to 290 within a day. That's a typical 2-year price movement within 1 day. Looking at Data Explorers proprietary data on Volkswagen, 13% of the market cap in Volkswagen ordinary shares was on loan on the 7th of October. This made it the most heavily borrowed stock in the DAX index. If we look at the preference shares, 16% of the market cap was on loan on the 7th of October. Now, what is interesting here is the fact that during the past 12 months, the ordinary shares have risen by 71%, while the preference shares have fallen by 28%. The typical trade here is to go short the ordinaries, long the preference shares. However, this trade has not been working and the premium has risen to record levels. On Tuesday, we've spoken to market participants and we understand that hedge funds were buying the ordinaries back at whatever price they could achieve. Certain portfolios may have been liquidated, causing a sense of panic, but then the price reverted to exactly the same price that it started at the beginning of the day. So, as Philip Dye will tell you, the markets will remain irrational for longer than you can remain solvent, and we saw that in Volkswagen on Tuesday. Finally, there's been a lot of talk in the markets amongst secure stock lenders that general collateral rates might rise given the recent market turmoil. We've looked at the Russell 2000 and we've looked at the cost for a hedge fund to borrow an average stock in the Russell 2000, and this has risen by 45% in the last in the last month. This is a fairly significant move, and we'll keep you up to date on other moves in this market.